Welcome to the video. Today we will walk through a disciplined, step-by-step plan for handling a sudden windfall, like a $100,000 inheritance, especially when your income is low or uncertain. First, we will slow things down with a protective freeze. Next, we will master the budget to understand your burn rate. Then, we will set up a slow-growth, low-cost, diversified investment approach using dollar-cost averaging. Finally, we will summarize the key takeaways and add a practical checklist. Let's begin. Here is today's roadmap. First, the financial freeze to protect your funds. Second, mastering the budget to know your monthly burn rate. Third, the slow growth mandate to avoid speculation and use dollar-cost averaging into diversified index funds. Fourth, a practical setup guide. Fifth, a short disclaimer. Lastly, a recap and an action plan. In this section, we start with protection. When a windfall arrives, the correct first action is to freeze the funds. Place them into a high-yield savings account or similar secure deposit. Then calculate your base monthly essential expenses, such as rent, utilities, transportation, food, and mandatory insurance. Set aside 6 to 12 months of those costs as an emergency fund. Next, enable account security and alerts. Finally, prepare a budget and simple automations. The sequence ensures capital protection before any investing decisions are made. Here are the immediate actions. Park the entire windfall in a secure and liquid account, like a high-yield savings account that is FDIC or FSCS insured depending on your country. Enable two-factor authentication, set withdrawal alerts, and consider daily limits. Calculate your essential expenses, including rent, utilities, groceries, transportation, required insurance premiums, and any minimum debt payments. Then set aside 6 to 12 months of these essentials as a separate emergency fund. Keep the remaining funds liquid during a mandatory learning period of 60 to 90 days. Avoid rushing into investments, gifts, large purchases, or speculative investment opportunities. This mind map shows the windfall at the center and branches into the key decisions: freezing funds, budgeting, building the emergency fund, slow growth investing via dollar-cost averaging, protections such as deposit insurance and beneficiary designations, and a periodic review cadence. It visually emphasizes that protection, budgeting, and emergency reserves come before investing. The slow growth branch highlights low-cost, diversified index funds and the avoidance of speculation. The review branch encourages quarterly check-ins and annual rebalancing. To calculate your burn rate, first list all essential expenses. Sum them to find your base living cost per month. Multiply this by 6 to 12 to determine your emergency fund size. Choose a learning period of 60 to 90 days where you keep remaining funds liquid. Create 2 sub-accounts, one for the emergency fund and one for operating cash. Set an automatic monthly transfer to maintain structure. Track spending weekly, and adjust categories to ensure you remain at or below your baseline. In this budgeting section, first define your baseline, which is the minimum essential amount required each month. Track spending using a simple system such as a spreadsheet, an app, or a physical envelope method. Aim to live below this line to extend your financial runway. The formula is straightforward. Your burn rate equals the sum of essential monthly expenses, and the emergency fund equals the burn rate times 6 to 12 months. For example, with a burn rate of $2,400, your emergency fund should be between $14,400 and $28,800. Automate bill payment dates to occur shortly after deposits to make cash flow predictable and clear. This table provides a sample essentials budget. The categories include rent at $1,200, food at $400, utilities at $200, transport at $180, insurance at $150, phone and internet at $120, and minimum debt payments at $150. The total base living cost is $2,400 per month. Use your actual numbers to compute your own burn rate. Quiz time. The question is, how large should your emergency fund be relative to your essential monthly expenses? Option A, 1 to 3 months. Option B, 3 to 6 months. Option C, 6 to 12 months. Option D, exactly 24 months. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is 6 to 12 months of essential expenses. This range provides a strong buffer and reduces the risk of needing to liquidate investments during a market downturn to cover necessary costs. This section outlines the slow growth approach. Avoid speculative assets and hot tips. Focus on simple, low-cost, broad market index funds such as total market or global market funds. Use dollar-cost averaging by investing a fixed amount every month to reduce timing risk. Keep fees as low as possible because expense ratios compound over decades. Stay the course, as time in the market tends to be more impactful than attempting to time the market. Review your allocations annually and rebalance if your allocations move outside of your target bands. This timeline shows the first year. Months 0 to 1 focus on freezing funds in a high-yield savings account and enabling security. Months 0 to 2 cover calculating the burn rate and fully funding the emergency reserve. Months 1 to 2 are for opening a brokerage account and selecting a low-cost global or total market index fund. From month 2 through month 12, you begin monthly dollar-cost averaging. From month 3 onward, perform quarterly budget reviews and check investment fees. Between month 6 and 12, consider adding a small bond allocation if your risk tolerance is low. At month 12, conduct an annual review and rebalance if necessary. This comparison contrasts speculation with slow growth. Speculation involves chasing tips, making concentrated bets, experiencing high volatility, and often making emotional decisions, which lead to uncertain outcomes. Slow growth emphasizes broad diversification, dollar-cost averaging, low costs, rules and automation, and a more reliable long-term probability of success. This setup guide shows how to structure your accounts and automation. First, open an insured high-yield savings account. Create 2 sub-accounts for the emergency fund and operating cash. Enable 2-factor authentication, alerts, and conservative withdrawal controls. Next, open a brokerage account and choose a low-cost, global or total market index fund. Schedule monthly transfers from your savings account to the brokerage and enable automatic investments for a fixed dollar-cost averaging amount. Finally, cluster build due dates shortly after deposits to improve clarity and reduce missed payments. This is an educational video, not financial, legal, or tax advice. Your situation may differ, so consider consulting a fiduciary financial advisor. Regulations and deposit protections vary by country, so verify coverage such as FDIC in the United States or FSCS in the United Kingdom. All investments involve risk, and principal can lose value. Second quiz. The question is, which approach best aligns with the slow growth mandate described here? Option A. Put 100% into a trending cryptocurrency immediately. Option B. Dollar-cost average monthly into a low-cost global index fund. Option C. Borrow on margin to double potential returns. Option D. Pick 5 hot stocks based on social media tips. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to dollar-cost average monthly into a low-cost global index fund. This approach is rules-based, broadly diversified, reduces timing risk, and maintains low fees. Key takeaways are as follows. First, protect the money by freezing it in a secure, high-yield savings account. Second, calculate your burn rate and size your emergency fund accordingly. Third, reject hype and prefer diversified, low-cost index funds. Fourth, automate investments and bill payments to remove emotion from decisions. Finally, review periodically while keeping fees and risks controlled. To summarize your next steps, move the Windfall to an insured high-yield savings account and enable strong security. Calculate your burn rate and fund 6 to 12 months of essential expenses. Open a brokerage account and select a broad, low-cost index fund. Begin monthly dollar-cost averaging and ignore market noise. Review quarterly and rebalance annually. Thank you for watching. If this video helped you protect your windfall, please like, share, and subscribe. Share your thoughts, questions, and your plan in the comments so we can all learn together.